One of the funny things about venture investing is that you only have to be right like 30-40% of the time, and you will be viewed as an absolute genius in the venture world. That's because like you're investing in companies that are like super risky, and a lot of them are going to go out of business. But if you can be right like at least a third of the time, like you will generate phenomenal returns and be like heralded as like having the Midas touch. So what does that mean though? That means that you're wrong more often than you're right. You know, as I've looked back through my career, I thought maybe it'd be helpful to share some of the mistakes I've made as a venture investor and some of the things that I've learned through that process, you know? They say that pain is the best teacher, and I've gone through a lot of pain over the years, as well as like having some really great outcomes on the other side of it as well. Anyways, hopefully some of the things we talk about today are helpful to you as you're navigating your own personal career and investing journey. I'm Peter Harris. I'm a founding partner with the University Growth Fund. During that time, I've had the privilege of investing and partnering with entrepreneurs in a variety of like great companies, including some that you may have heard of like Spotify and Snapchat and Postmates, and have had the opportunity to learn from both like my successes and a lot of my mistakes. And that's what we're going to talk about today. I will note though that I can't really go into too much of the specifics of the companies because a lot of the data and the information is proprietary, and I don't want to get anybody in trouble. That's also why most times VCs don't talk about some of their failures because of the proprietary nature of it. Also because like nobody really likes dredging up the past and facing kind of their demons. But I do think that like there's a lot to learn. I want to share some of those things with you. All right, so mistake number one, investing in a party round. So first of all, you have to understand what a party round is. It's usually like a very early stage, like seed stage investment round where there's a company that's like got this hot idea and some entrepreneurs that are like well known and really like charismatic. And rather than going to like a large venture fund to lead the round, if you will, like price it, take the board seat, like write the largest check, really be like the main force behind the fundraising round, the entrepreneurs just like get all of their buddies together. You know, maybe even a large venture fund will participate, but they write a relatively small check. So like this could be like you raise like $2 million, but you're raising it at like 50 to 100K checks. And so that's the party aspect. Everybody's like throwing in money and it's a good time. And, you know, the terms tend to be like really entrepreneur friendly. And yeah, it's like a party, but like just like a party at, you know, your friend's house when their parents are away, like nobody's really in charge and it can quickly devolve into a total disaster. That same thing oftentimes happens with these party rounds. And like our fund, like we don't really do seed stage investing. But I kind of got hooked in with this one company that had a lot of those characteristics. It was super hot. Like the idea was like really interesting. The founders like really ambitious with some great experience, very charismatic. They pulled together this round and I thought, you know, hey, look, like this is a really cool, you know, compelling opportunity. We should kick in a little bit of money here. And if it's successful, then like we'll double down in the next round. And that's oftentimes what happens. Like if these companies are successful, like they go on and they raise more money from larger venture investors who will lead their Series A and take the board seat and do all these things. And so it really doesn't matter that it was a party round in the early days. The downside though is that these party rounds, like I said earlier, they tend to be very entrepreneur friendly, which means that the terms might be like really aggressive. Like the valuation might be really high. And the next investors look at it and say, I don't want to pay that high of a valuation. And so they walk away without even coming to the negotiating table. So it makes fundraising harder. It also is more tricky because there's not like a major investor that's helping push the company forward towards a fundraising event. And lastly, there's nobody really to hold the company accountable. If you diversified and diffused all the responsibility, then nobody has like that say or that power to come in and really push the entrepreneurs to do the things that they need to do. In some cases, over the last couple of years, there's been a lot of talk about like, oh, you got to be entrepreneur friendly in order to win the deals. But that has also backfired. I mean, you look at the cases like Elizabeth Holmes or Adam Newman with WeWork. These founders were given like so much control and opportunity. It's like that saying like absolute power corrupts absolutely. Like definitely occurred in multiple instances. Like, you need, for a healthy relationship, right? Like, you need somebody to be able to push back on you as a founder and hold you accountable and kind of hold your feet to the fire a little bit. And that doesn't happen with party rounds. And so lo and behold, we invest in this party round. A year goes by and the founders call me up and they're like, hey, we need more money. And I'm like, well, what have you done with the money we gave you? And we thought you were going to raise a larger round. Like, you told us, like, you were just a month away from raising a larger round. And, like, they hemmed and hawed and said, like, the market changed on us and we had to pivot our business and like all of these things. But ultimately what we discovered is like, we were one of the larger investors as a fund that's like primarily a co-investing firm. Like, we don't lead rounds. That's not what we do. And so we weren't like positioned to come in and save the company. And it really opened my eyes to like all the things I just talked about with party rounds and why they can be dangerous. This company was in a tough spot, like needed to go out and raise money from people, but there was nobody that had like super high conviction because they had already written a larger check and was responsible enough to write that subsequent check. At the same time, there was nobody on the board either to really hold them accountable and really push them to address certain changes that they had needed to make earlier on. Anyways, for me, like, party rounds can be interesting, but probably something I'm going to avoid in the future. And if you're going to invest in a company and you're not going to be the lead investor, make sure there is a good lead investor. Make sure you know them. Make sure you have a good relationship with them. Make sure you trust them and that your interests are aligned with theirs. Otherwise, it could come back to really bite you. Mistake number 2, confusing growth with product market fit. Now, product market fit is like the holy grail of what startups are looking for when they raise a seed round. Raise the seed money, you build your product and you start going to market and trying to convince customers to buy your product. When you've achieved product market fit, it starts to be less of like a pushing your product on people and more of a like customers are pulling the product from you, right? They need it, they want it. And there's a lot of those customers. And so when you start to feel that pull, that's usually like a sign of real product market fit. Now, oftentimes as a venture investor, you'll see like really high growth. And that tends to be a leading indicator that like a company has achieved product market fit. And typically, like as a fund like ours, where we really invest at like the Series A stage and later, we're looking for like $1 million to $2 million of revenue before you feel like they've got real product market fit. So as that is context, we looked at this deal and actually ended up investing where the company had grown like 8x in a year. So just phenomenal growth, super crazy fast growth. And at the time, like I was like, wow, they're doing something like really compelling. They're growing really fast. Like obviously the pull is there. Like customers are begging them for the product. And that's why they're growing so fast. Well, it turned out that the reason why customers wanted the product so much was because there was a services component to the software. And people really wanted the service. And the company had basically lowered the price of the service compared to everybody else to get people engaged and onboarded so that they would buy the software portion. The challenge is that people would come on, they would use the service at this like highly discounted rate. And then once it was all up and running, they would ditch the software product and churn. And so the company had like super high growth because they had, call it product market fit, but they had it for the service side of the business, which was not the core part of what they did. And the business had to go through an incredibly painful like journey through the wilderness to pivot the business so that they could find something that customers truly wanted on the software side and fully ditch and spin off the services side of the business. For me, that was like a big eye-opener that I needed to be a lot more careful in when analyzing the businesses to not just get caught up in the growth of the business, but to really understand, do they really truly have product market fit for the company or for the business model that will ultimately be the one that drives the biggest return over time? Because the services side of the business was not scalable. They were basically giving away dollars for 50 cents in hopes that people would convert over to the software side of the business where they could really monetize them and do it in a scalable way. Ultimately, this investment turned out all right because the entrepreneur was fantastic and really like rolled up their sleeves, made the hard choices and the hard decisions and pivoted the business and helped it get to a point where it achieved new product market fit with a new market and a slightly tweaked product that really ended up taking off, which came back and really illustrated the importance of investing in great founders. But investing in great founders is never quite enough. And that brings me to mistake number 3. The next big mistake I made was not trusting myself on the market. So what do I mean by that? Like, we made an investment in this company where The founder was phenomenal. The product was like top notch and won all kinds of awards. You know, it had a lot of the elements like high margins, like a lot of great things about it. Really high NPS score, like people love the product. There was a lot of things going for this business. In the back of my mind, I just like didn't feel comfortable with the market. And I convinced myself, because I was so enamored with the founder and the product and everything, that I was like, you know, they'll figure it out. They'll figure out the market. Even to that point, like the founder was like, yeah, we're like in the US and it's going okay, but like in this other market overseas, it's going to be so much better because like culturally, like they're going to need this product and they want it and they're willing to pay a lot more for it than they are in the US. And I let that be like the excuse for what I was watching happening in the US to justify making the investment in spite of that. Because in the US, the market was a really tough one. People weren't willing to pay that much for the product. It was very like multiple layers of bureaucracy to like make the decision to buy it. The need and the pain point wasn't like super strong. It was just like okay. It was like a nice to have, not a must have. All of those dynamics were happening in the US market, and I didn't do my diligence, frankly, to understand this overseas market and why it was going to be truly different than the US market. Well, fast forward, sure enough, turns out that the overseas market was not vastly different than the US market like we had hoped. It never ended up fully materializing, and the company had to pull back and just focus on the US market. The other thing that I learned is this business had a hardware component to it. Hardware is hard. And one of the things that I learned about that is one of the things that's hard about hardware is that your product gets stale over time. So one, it's very capital intensive to do the R&D, to build the product, to have it manufactured. Then you get it over here and then you're selling this hardware. And within a year or two, it's obsolete practically, given like how fast technology advances and develops. And you have to have the money to go and restart that whole process. Otherwise, you basically become irrelevant. And so it can be really challenging to operate a hardware type business. Now, in this case, a lot of what they were doing was like pure software, and they were able to get a ton of life out of their hardware side of the product, but it still presented like a meaningful challenge to the company, and one where now when I evaluate a deal, I think really hard, not just about do I have the right team in place? Do I feel like this founder is the right founder? But also like, is this the market where we should be investing? Does the product and the market mesh? Are they creating a product that the market just desperately needs and is solving like a massive pain point? Or is it just a nice to have? In my prior example, I talked about how I confused growth with product market fit, but ultimately the founder saved it. The reality is like you just can't bank on that happening every single time. In this other example, it had a phenomenal founder, and he tried multiple times to pivot the business and find a way to make it work and ultimately couldn't. And that's because getting product market fit is really, really challenging. So when you're evaluating it, some people will say it's the jockey, some people will say it's the horse, the jockey being the management team, the horse being the market or the product. For me, it's both. If you have the combination of both, an incredible founder with a market and a product that fits and meshes well together, you will win every single race. Anyways, those are some of the things that I've learned throughout my journey. Share some of the things that you've learned down in the comments below, and I'd love to like create a discussion on the different things that we can learn from each other's mistakes to help us make better decisions going forward. If this video is helpful, please like and subscribe. Please check out some of my other videos, like this one where I interview the team from North Cove about their current WeFunder campaign. Thanks.